All right, seeing none, let's move on to the preliminary 2021 corporate operating plan.
Thank you, Director Bogner. This is my fourth year presenting these, going back to 2017, my first year at OPPD, and it is fantastic just from a personal perspective, seeing the evolution of the quality and the messaging and really the commitment of the organization to deliver efficient operations, and this one marks the 5th year of a no general rate increase for our customer owners. Huge commitment. I cannot emphasize this more. Not everybody can make these type of commitments while maintaining financial sound financial metrics, and we are doing that again this year. So 2021 would mark the 5th year of our commitment to a no general rate increase. So with that, let me talk a little bit about the assumptions first. I think that's important. Purchase power, we're planning to keep that the same. However, there will be a proposed change to the fuel and purchase power base rate. Now, our general rate increase commitment to stay flat stays the same. So it's really just how the different components of the rates are changing without changing the overall rate. I'm going to talk about that in more detail here in a few more slides. But this is, if you remember, last year, 2020 was a big transition year, where we have been adding a lot more wind. We've been playing in the SPP marketplace a lot more. And we talked about the need to change the way we budget purchase power, off-system sales. They were not necessarily syncing. The way we budgeted them and the way we charged them in rates were not necessarily in sync with what we were seeing in the market. So in 2019, we had a huge dislocation between budgeted off-system sales and actual off-system sales, and budgeted purchase power and actual purchase power. The deltas were huge between those two. So in 2020, we took the action to I'm going to call it fix, but it's really to calibrate that and to change that that relationship. We asked for a resetting of the purchase power base rate in 2020 to account for those changes that we had been seeing in the past. I'm very happy to report that the new methodology is working well. Even in the COVID environment, even in this low natural gas environment, our new methodology is working really well. To the point that we are ready now to make another change and resetting that fuel and purchase power base rate to very close to what used to be pre-2020, so what we had in 2019. You're going to see this here in a few more slides, but that's really that resetting that purchase power base rate to what it was without changing the general rate. Retail energy sales, we are seeing a 3.3% increase from the 2020 budget. I want to say that the majority of that is, we're seeing that from industrial customers. We're not necessarily seeing a lot more people moving into the territory or using a lot more energy. It's really a reflection of all the economic development activity that we've seen here in the previous years, and we're gonna hear from Lisa Olson here soon. Economic development. This is what good economic development looks like, and this is really reflective in how we're putting together our budget. Now, it also reflects a 4.2 increase from the 2020 projected, and that's because in 2020 we did see a decrease in energy sales, mostly commercial customers. So we're projecting that some of those commercial accounts will rebound and we'll start using more energy. Not fully rebound, not fully recover from COVID, but we are expecting that to have a positive rebound to energy sales in 2021. Wholesale revenue, this is an interesting one. We're expecting a 15.5% decrease in wholesale revenue from 2020 on a budget basis. And that is because in 2020, we didn't have any major outages on generation planned. We had a few, but nothing major. In 2021, we're going to have 3 major outages. So by definition, we're expecting to generate less power. That is a 15.5% decrease from what we budgeted in 2020. It's because of the outages. However, because of what I explained earlier today on market prices. We're expecting to basically generate about the same amount of revenue from the 2020 projected wholesale revenue. So it's almost flat to what we had this year, but it does reflect a decrease to what we had budgeted for because of the planned outages. And I'm going to talk about the planned outages here in just a minute. Purchase power, it's about an 11% increase from both the budget and projected, where we are projecting to buy to have the need to buy more power because of the outages that I just mentioned on the wholesale revenue. So it's an offsetting effect. Wholesale revenue goes down, purchase power goes up. We are anticipating to have to buy more power from the market because our units will generate less because of the planned outages. Any questions on this slide? Okay, Mo, could you please move to the next slide? Capital expenditures, operating and maintenance. We spent a lot of time making sure that we're not leaving any function behind. The board of directors has asked us very clearly, there are 15 strategic directives that we have to meet. And so we are trying to make sure that everything is taken care of, from reliability, safety, and equipment availability factors, all the way to employee engagement, customer satisfaction, safety, and everything in between. So you will see here later we've asked new generation strategies to continue to make to study, give us an opinion on whether or not our levels of expenditures and programs are adequate for us to continue to operate the utility in a prudent way. So we're very, very much keeping status quo and improving on our operations. Our total 2021 budget expenditures, $1.4 billion. That is higher, significantly higher than we've had in the past. The biggest change of that is the capital construction of the natural gas plants that are part of Power with Purpose. That's what's explaining that increase from almost 1.3 billion in 2020 to 1.4 billion in 2021. We're going to be entering a heavy construction time frame in the next 3 years that should result in budgets that are of that size, I would say, for the next 3 years. Financing, because of the large capital portfolio we have, we want to make sure that we don't divert our attention to just the shiny new project, but that we continue to invest in our existing infrastructure. There's a slide later on where I'm going to talk about sustain versus expand projects for infrastructure. The new money revenue bonds, we're anticipating to issue debt, new money revenue bonds, to net proceeds of approximately $160 million to fund the 2021 capital expenditures that come with our Power with Purpose, our natural gas peaking stations. The actual dollar amount is going to be different. It won't be $160 million. It'll be whatever the dollar amount is that generates $160 million in proceeds. Municipal bonds are often sold in this environment, very likely in what we call original premium bonds. So we'll likely issue less par amount in bonds, but it will yield about $160 million of bond proceeds. Then going down to Fort Calhoun nuclear station, continue to work on that project. Very proud of what Mary Fisher and her team have done on that project. 2020 was a huge year, moving all the fuel into the HPC dry cask storage, and now really busy working on the remaining of the building. Budgeted contributions to the decommissioning trust funds next year are $129 million, and we're planning, or the budget for expenditures next year is $123 million. We also continue to fund the restart and recovery amortization of $15 million. This is related to the 2011 flooding, when Fort Calhoun had to be brought back online. There were expenses that we incurred back then. the board back then chose to use regulatory accounting to amortize those additional expenditures. The last year when we will recover this is 2023. So this was a 10-year amortization starting in 2013, ending in 2023. So we're also including that amortization for the 2021 budget. Any questions before I move on to the next slide?
There are no hands raised right now.
Okay. Next slide, Mo, please. On the reserves, I already talked about these. We continue, well, maybe I didn't talk about the rate stabilization. We do have a rate stabilization fund fully funded at $50 million. We're not planning on increasing that one or withdrawing from that, of course. And we are not planning increasing the decommissioning and benefits reserve accounts in 2021. Now, if the year goes by and we find ourselves in a situation where we could, that's a decision that we will make at the end of 2021. But going in, we don't have any plans to augment that account. And then on the major outages, budgeted major outages, we have Nebraska City Station Unit 1, 2, and North Omaha Station 5 with major outages. There will be other outages in our peaking stations and others, but we don't qualify those as major. These are major outages where the units will be out for several days at a time, and you know, it's all hands on deck to perform a lot of the work that Mary has been discussing with the systems committee on those outages. Any questions here? Okay,
No,
so
I don't
next.
see any.
Javier,
Oh, yes, Mike.
hey, what is the current balance of the rate stabilization fund?
It is $50 million.
$2 million. Okay, and as far as the decommissioning and benefit reserve accounts, isn't that pretty much earmarked for Calhoun, that we wouldn't be able to use that anyway, could we, for general purposes?
That is restricted. The use of those funds would be restricted to be used either on the decommissioning project or to fund benefits. And so when I talk about benefits, that's a pension piece. So as we continue to fund the decommissioning trust funds and as the teams continue to tackle all that work, there's less and less risk of not being able to fund the decommissioning project. The work is being done and funding continues to happen. At some point, the board will have enough assurance that we have we're on a pretty good path to funding our decommissioning project, and that is when the board will have the decision at some point in time, is this the right time for us to now use the funds in this account to fund benefits, or in this case, the pension fund. So it could be used for those two, but your point is right, Director Kavanaugh. It can't be used for anything else without board approval. So we couldn't just use it for any other program.
Okay, thank you.
Yeah, you're welcome. Okay, next slide, please, Mo. Okay, so by formula, again, OPPD recovers our costs incurred for fuel and purchase power using this fuel and purchase power adjustment. The way we do this, it's we look backwards, see how did the OPPD perform the last year? Did we under-recover? Did we over-recover funds as of last year? And then we use these fuel and purchase power to calibrate and to change the way we are charging for fuel and purchase power in the following year. So there's always a rear view mirror perspective on this one. We have that base rate, and then we have the adjustment that adds to the base rate. We are recommending, as I mentioned earlier, resetting the base rate while leaving the FPPA factor unchanged. It will not cause a rate increase or decrease in retail rates. And this is really to acknowledge that we've calibrated our budget well enough. The transition from 2019 to 2020, where our budgets are much better aligned today to market and actuals than they were back in 2019. So the recommendation, if you go to the next slide, Mo, please, would be to move the FPPA base rate back to very close to where it was in 2019. What you see on the graph on the right, it shows a stacking up of rates. The FPPA factor at 0.186, the FPPA base rate that we're recommending at 2.095, and then the all other rates at 9.209. All in all, still results in the same 11.49 cents per kilowatt hour. That's illustrative average cents per kilowatt hour. This is not the rate, overall rate for everyone, but it's an illustrative way to show that we're not augmenting or increasing rates. It's just how we're reflecting the fuel and purchase power nature of the markets we're in, and how our budget continues to adjust, and it's putting us in a really good position going into 2022 with a much better calibrated budget that reflects the latest version of the markets. Markets continue to evolve, and so 5 years from now we may have a different discussion. But I feel very comfortable proposing these change. Again, all under a no general rate increase principle, which is really, really important. Any questions or comments on these?
Director Williams.
Javier, does the change in the fuel and power purchase power, does that appear in any of the tables in the rate manual, or can you remind us where this shows up for people to make sure they can track it?
It will be a board action because it's changing the rate, and yes, it is. And I can call in a friend here, Brad Underwood, if you're around. It's scheduled 461, where you can see that fuel and purchase power adjustment. So that's the one that will change going into 2021. But again, what I'm showing here is our commitment that the overall rate cents per kilowatt hours that customers will see in their bill is not changing.
Yeah, and I think you and I talked about this a little already, but the 11.49, as you mentioned, was illustrative, and that's not actually what the rate says in the rate manual, and so this is different from what will be reflected. And by extension, then, what shows up on the bill for customers is tied only to what's in the rate manual itself, under 110 for residential, for example, or 461 for this charge as well. So I guess I just want to make it clear that the numbers that we're seeing now, that if anybody is watching this and saying, I don't see 11.49 anywhere in my bill, I don't see this other stuff, that for residential, again, rate 110 for most people, and then 461, as you mentioned, is the place where the numbers that are translated into what appears on the bill are located, so that people can, if they would like to research it, know where to look for that information.
That is absolutely correct, and they can always, if there's anyone who has questions, they can always call. Our call center folks are fantastic, and they can help walk through and explain. This is just a pictorial; it's for illustrative purposes, but I think it gets the point across. That's why we chose to present it. But thank you for the clarification that this is not the rate. It's rather how rates and how revenues would compare 1 year to the next, and showing our commitment to the no general rate increase.
There are no other questions right now.
Okay, so let's move on to the next slide. Retail revenue, the story here, again, going into the no general rate increase commitment. One would wonder, well, how is it that last year in 2020 we're projecting $980 million in retail revenue, and 2021 has over $1 billion in retail revenue? That's $24 million more in revenue. How are you generating that if you're not raising rates? And the reason is, well, we are experiencing growth. If you remember that comment I made on load growth or energy sales of 3.3%, that is how. You can see commercial depicted in blue in the middle, staying pretty steady, maybe a slight decline in commercial revenue, slight decline in residential revenue, pretty flat. But it's really that industrial category at the top in the gray squares. That's where we're seeing that increase of retail revenue. It's economic development. It's new industrial customers using more. That it's causing that increase in retail revenue, even though we're still on our no general rate increase period. Okay, next slide, please. Wholesale revenue, I already described this a little bit earlier. 2020, our total wholesale revenue is 100, or it's expected to be $138 million by the end of the year. The blue bar, $67 million, is what we're expecting to receive from our 7 participants on Nebraska City Unit 2. They pay to purchase the revenue that they are entitled to on that unit. So that's the blue section. The what is it? Brown, reddish. I'm really bad with colors. That block, the bottom block, that one is the rest of our wholesale revenue. We're anticipating to sell more megawatt hours in 2020 than we're expecting in 2021. But in 2020, we received less dollars for that energy, and that explains that $138 million wholesale revenue. 2021, it's just a coincidence that it's $138 million. We're expecting to sell less into the market because we will have 3 major outages, but we're expecting to receive a little bit more per megawatt hour. So all in all, it results in the same wholesale revenue from 2020 to 2021. The next slide, it's other electric revenue.
Director Noter has a question. Sorry.
Yeah.
That's for him.
Yeah, thanks. And I'm sorry, I'm tardy on asking a question on the previous slide too, but we'll start with this one. So what I see here in the wholesale revenue is that the non-NC2 participants, so the broader market, was up in 2019, was up a lot more in 2018, is down in 20, and then you expect it to go back up. So can you give me kind of a trend analysis of why it was up and was trending downwards and you expect it to go back up?
Yes, so thank you for that. So 2018, let's use 2018 as a good barometer. Really, we have the same number of units, the same fleet profile in 2020 that we had in 2018. We have a little bit more wind. We added shoals, but from a generation perspective, it's almost the same fleet that we had in 2018 that in 2020. All things being equal, so no COVID. That felt good when I said no COVID. No COVID and energy prices being normal, I would have expected 2020 to look very much like 2018. So those bars would have been higher. In 2019, we had a decrease because 2019 we had 2 major outages, actually more than 2. But we had that Nebraska City 1, Nebraska City 2 major outages. I think North Omaha also had outages. So 2019 was an outage year. That explained the drop from 2018 to 2019. Again, all else being equal, I would have expected 2020 to rebound back to 2018 numbers. And then 2021 to come back down because of the outages. So that's how the trend is explained. 2020, again, being an anomaly here, it makes it hard to compare. But again, all else being equal, I would have expected 2020 to look more like 2018 than it does here. I hope that helps.
That was very helpful. And recalling someone once said, predictions are hard, especially about the future. But given that explanation, you might forecast with all the appropriate caveats that 2022, since there won't be, hopefully by then, and certainly won't be the outages, we would see our wholesale revenues moving back upwards, kind of maybe to the 80s, 90s, whatever. But certainly more than in the 70s.
That is correct. Again, all else being equal, that would be expected. Now, the other piece here is there's a slightly negative factor in there, and that is as our load grows, right? And we haven't necessarily added more generation. That will come sometime in 2023 once we have the peaking stations. But in 2022, that higher load from industrial customers is going to take some of that production. So we won't put in as much out to the market. So that may damper a little bit the wholesale revenue. But again, all else being equal, your narrative is correct. In 2022, we should expect to see a jump to look closer to what we had in 2018.
Thank you. So, Ms. Hinders, if we could look at the previous slide, I did have a question on the retail revenues as well. So I'm seeing that the industrial growth occurs, and we're seeing less in commercial and residential in terms of retail revenue. Aren't losing customers there? So is that correct? And if that's correct, then why are there lower revenue amounts?
We are actually, I don't have the data in front of me, but so it's not only lower energy sales that we're projecting on commercial accounts. We have experienced that we are assuming that we will have fewer commercial accounts than what we had expected in 2020. So there are lower accounts. Businesses are shut, and we expect some of that to continue through 2021. At some point with the economy, at some point they will come back or others will replace them. But we are expecting not only lower sales, but lower accounts. In for the residential side of things, we're expecting it's the same. Actually, we're expecting a growth in the demographics of the region. People continue to use more efficient homes, as you all know. All these newer homes are using less kilowatt hours than older homes. So we're benefiting from that. I shouldn't say natural occurring energy efficiency, because Director, you've told me it's not naturally occurring. We've all been helping to get there. So we're seeing more people. They're probably using less. Part of what we saw people using more in 2020, again, remember we had a lot more students learning from home. We had a lot more people working from home. We likely won't have the same amount of people for the same amount of months working from home in 2021. And also 2020, we had an extended summer season. We had lots of cooling degree days. And so we're not assuming that that's going to be the norm. We can argue about that separately, but from an average perspective, we're also assuming an average year, which it helps explain that slight decrease in residential revenue.
Terrific. Thank you for those great answers.
Yeah, you're welcome. And I have a little voice whispering on my other screen here. You can page 25 of the actual document of the COP has a lot more information on these particular topics. So if you want, there's more in there.
All right, Director Mulhall.
Sure. Thanks, Javier, for that explanation. So at what point, so noting because of the COVID, we have a lot of debt that is greater than 90 days and a lot more this year than last year. At what point do we write that off, and would that have an impact on any of these numbers or any of these projections? Because it is significantly larger than it has been other years.
Yes, so thank you for that. We are assuming, so part of the and you will see in the COP document, but part of customer accounting and services expenditures include write-offs. So it includes all of the assumptions that we use for write-offs, and we're paying close attention to not only historic trends but recent monthly trends on how this is affecting write-offs and late payment charges and delinquent accounts. All of that helps shape how we assume write-offs into the budget. Also, how we assume late payment charges into the budget. That's a revenue as opposed to an expense. But it's all of those things are incredibly important, and we're not just making gross assumptions based on long-term history, but we are honing in more closely into what we've seen in the past 8 months of this pandemic. And in fact, if you allow me, I think it's the next slide. No, the next one, that one. You can actually see here one of the elements that I just discussed at the very bottom of the graph, that maroon or brown square. It shows late payment charges. So it shows what we've received in the past on late payment charges. It shows what we're expecting to receive from late payment charges. There's a correlation between that and what we're expecting to have as an expenditure on the write-off side under our customer accounts category of the budget. So very much we're paying a lot of attention on what are the trends and how are we accounting for write-offs and late payment charges going forward. Does that answer your question? Okay, thank you. And I apologize. I moved on to this next slide just to make the point here, but I'm happy to go back if there are any other questions. There
are no other questions right now.
Okay. So other electric revenue, as you see here, it's $36 million. It's not the bulk, of course, of our revenue out of 1.4 billion, but it's important just to show what else, in addition to retail sales, where else do we generate revenue from? It's really interesting. You can see the top square, that light green square on transmission SPP. Back in 2017, the revenue we used to receive from the Southwest Power Pool for our transmission infrastructure was about $4 million. As we've added more infrastructure and as the region has become more complex and they are relying more on our infrastructure, we have seen that revenue increase. Now, conversely, and I'm going to talk about that later on, we've also seen our SPP expenditures increase because we are relying on other people, other utilities, transmission infrastructure. So it cuts both ways, but it's reflective of the more complex and integrated market that we are today than we were 5 years ago. Moving on to the next slide. O&M. Okay, so operations and maintenance expense. This does not include fuel or purchase power. And it does not include, of course, so the graphs that you see here obviously don't include the Fort Calhoun decommissioning because that's not an O&M expense anymore. What you can see here, it's the split between, actually no, I misspoke. This graph does include fuel, purchase power, administrative and general, transmission and distribution, production expenditures, even though it looks like we're going from 143, and my camera stopped working. Is that by design, Mo?
You were breaking
Yes,
up.
you were breaking up, Javier. I got the yellow low bandwidth thing, so we can hear you better now.
Perfect. Thank you. It wasn't failing. $143 million from 2020 to 2021. So one could say, hey, there's not a lot of change in here. Now remember, in 2020, we've used less fuel than we had projected. In 2021, we're expecting to go back to using about the same amount of fuel that we've used in the past for the fleet that we have. But we are expecting to pay a lower price for the fuel and the delivery expenses of that fuel. So you all heard, and you were all part of the presentation and discussion about transportation of fuel. That is reflected in here. That is a very, very important piece that helps our budget for 2021. Keeping those fuel costs lower. It's basically moving them down from somewhere in the $170 million that you saw in 2017, 18, or 19, down to $140 million for 2021. I skipped 2020 because it was an anomaly year, but it's really just to compare those savings. Purchase power is going up. Again, we're having outages, so we're expecting to buy more power than in previous years. Similar to the purchase power number that we had in 2019, maybe a little bit more. We had more load to serve. Very excited to report on the administrative and general increases, going from 29 million to 144 million. Now, it may sound counterintuitive that the CFO is excited that we're spending more money, but there's a story behind this. It's not spending more money for the same work that we were doing. I'm very excited about this because my colleagues at senior management have done a fantastic job transforming the organization. I'm going to mention in this case Kate Brown with the Business Technology Building Services. The investments we are making on people, software, technology is very much evident in this budget. Those increases are helping us meet the demands of our customers, the demands of the time, really modernize and I would say pay off some of that technological debt that we've been carrying for years. Is it enough? Are we going to be done in 2021? No, but it is certainly a way for us to continue to show our commitment to invest on technology. Same thing on the orange box, transmission and distribution. Troy Vai and his team, they continue to do a lot of work. Part of these increases, again, we have customers. We have a lot of customers who are asking us to do a lot more work. But the other piece is very, very much tied to the strategic initiative on the grid modernization efforts, and really making those investments in technology and infrastructure, people, in data that we need to achieve that vision that we have set forward with that initiative. The increases in production are similar. Part of that is the outages, of course. We have more outages than we had in 2020, so we're expecting more expenditures there, and also an increase in the customer accounts. It's again same story. We're updating systems. We're updating our billing systems. We are adding people to help with our call center. Our products and services department is doing a lot of really good work. So it really reflects that additional work that we're able to accomplish without raising rates. So that is, to me, that last sentence is the key, right? We're saving a lot of money on parts of the organization. We are increasing expenditures to do more for our customer owners, and we're balancing those two in a way that doesn't increase general rate for the public going to 2021. Any questions here?
No questions right now.
Going on to the next slide, you can see the obvious increase on that right column. What's happening with capital expenditures. That is power with purpose. That is the explanation there. You can see there is transmission and distribution plant continues to be healthy. We continue to invest a lot of money in our transmission and distribution, but the big increase that you see from 2019 to 2020, that started to show as power with purpose. But really, going on from $82 million in 2020 to $193 million in 2021 reflects the big installment of payments and investments that we are planning to make as part of our peaking stations in 2021. It's not all. These projects are expected to take 2 to 3, maybe 4 years to completely finish and spend. Our commitment is to have these done by 2023, but there might be some other expenditures happen afterwards. It's really 2021, 22, and 23 that will have the bulk of the expenditures for the production plant. Let me just check my notes, make sure that I'm not ignoring anything here. So on the actually no, I'm going to save my comment for a future slide. So, unless there are any questions here, I can move on to the next slide.
No, you can move on.
Okay, so you can see on the next slide, power with purpose, again, $172 million total capital and indirect cost assigned to that. We're calling it one project, power with purpose, but it's going to be several, depending on which project moves faster or others. We have RFPs out for the different equipments, different locations, but this is a really good estimate for what we know today. I want to point out we have of course, circuit and substation upgrades, fiber network expansion. You've heard about these projects in the past. I want to focus a little bit on that transmission distribution cable replacement piece. This is a really good story, one that I am very proud to report. We have this. It's an underground cable. Sometimes we refer to it as unjacketed cable. We've had, cables that were installed many years ago, decades ago, that have been the cause of some of our failures in the region, some of the outages. We've identified that many times, and so we've had a commitment to gradually make investments to replace that type of cable in the region. I want to point out that in 2021, the budget we have for this type of cable is $8.2 million. 2016, just 6 years ago, that budget was $700,000. Now the cable hasn't gotten any worse or any better. It's been there all this time. The type of information that the team has been able to get, the statistical analysis that we've been able to get, is allowing us to look at this problem in a much better way, much more transparent, and we are now seeing the need to replace it, the benefits of replacing it in less frequent, lower duration outages, but also how large is this project. So we've increased the funding on this one project. I'm just pointing it as an example, from $700,000 in 2016 to $8.2 million today. And that is, in my opinion, that is the power of good data and good information and collaboration between all the departments. I have to give a huge shout out to Troy Vai, Dan Lenehan, and their teams for that partnership and helping us identify, prioritize, and make these a reality. It's not just exclusive to transmission and distribution. Mary Fisher in energy production, Kate Brown in business technology, building services. I'm seeing that all across the board. I wanted to focus on this one project because it makes me very proud to see. I've seen the evolution, the type of discussions that happen in the prioritization table, and to see our commitment to put in this amount of money to improve reliability is something that is something to be proud of, in my opinion. Next slide. Then on the next slide, I'm going to talk in the same vein. This is a view of our capital project, of our capital portfolio. This is the first time that we're presenting it this way. We've been talking about sustain and expand categories, but we really didn't implement that lens until this year. Earlier this summer in 2020, the teams met for many times, many hours, prioritizing the capital portfolio for 2021. And a very important lens that the team used was making sure that we had a clear distinction between what we call expand projects versus sustain projects. Without being critical of OPPD in the past or of other utilities, I think this is just human nature. What I've seen happen in my former utility, I saw that happening too, was there's a tendency to focus on the new projects. And when we focus on new projects, we tend to forget the old projects. For example, the underground cable project that I just mentioned. Well, if it's still working, if it's not breaking, there's a tendency to forget about those and say, hey, we can wait 1 more year or 2 more years. Let's focus this year on the expand projects. We could have done that in 2021. We could have focused most of our capital budget for the Power with Purpose project. But that would have come at the expense of dedicating less dollars to the sustain program. And so I'm very proud of the team that was able to keep those two angles visible on the table without creating any more technological debt or infrastructure debt, and at the same time expanding our plant. So very proud to show that we are still dedicating 43% of our capital project, $161 million to sustain projects. Very similar, very close to what we've done in the past. Don't lose sight of the sustain, keep our assets in good working order, and at the same time also focus on the new assets that we're very proudly pursuing and wanting to build. So expect to see more of these. This is really a result of implementing a a new asset management function at OPPD, and what you're seeing here are the results of about 3 years of really hard work from the resource planning committee and from the capital investment team.
We do have a few questions related to this slide. I'll start. Do you think this 60-40 split is about right for us every year, or is it going to be very dependent on what's happening in the district?
Yeah, it varies. Thank you for that question. It varies. I do not expect this to be the case forever, right? We will very clearly have a larger expand budget for the next 3 years. After 2023, I don't know. I don't know what are we going to be doing then. I don't think there is a sweet spot, if you will, for all utilities. It really all depends on what you're doing. In my former utility, we used to have a lot more of sustain and very little on expand. Arguably, OPPD has had most sustained capital investments and almost very little, almost no expansion. So it really depends year over year, but this view helps us match where are we spending our dollars with where the board wants us to go, right? And make sure that we are not losing sight of the sustaining our investments versus expanding our plant. I expect this to remain this way for the next 2 years, 21, 22, and 23. It's going to look very similar to these. And then by 2024, very likely we'll see sustain be most of the capital budget more than expand.
All right, thank you. Director McGuire.
Yes, Javier, and this might be Troy's question too. Last year, one of our priorities was tree trimming budget. Can you comment on that? Are we going to maintain the same amount of tree trimming budget as we had last year?
Yes, we are, but I can let Troy answer.
Yeah, that funding will stay consistent. We're on a several-year plan to reduce some of the trimming debt that we have in our service territory. So yes, that doesn't fall in the capital expenditures. That falls in O&M. But yeah, we are keeping that activity. We have additional crews in our service territory, and we're making some pretty good progress. For instance, we'll trim about 1,000 miles this year.
Okay, thank you.
Director McGuire, if I may, so on Thursday of last week, I was invited. I was a speaker at a conference that focused on asset management. And I actually brought up the tree trimming example to that conference. And my point was, you know, a lot of times our investments don't always have to be on the actual assets we own, but it's on the things that affect those assets. That's another decision that I'm very proud of that we made last year, a couple of years ago, on making sure that we are trimming those trees. We don't own those trees. They're not part of our asset base, but they certainly affect our asset base. So making sure that we're looking at capital expenditures and O&M expenditures together to see how we can extract the most value out of our assets.
All right, Director Mulhall.
Yes, Javier, I really want to thank you for this slide. I think it's so important that our customers realize that we're not just here to serve the shiny new customers like Facebook, Google, and now Amazon, but that we are really working hard to make sure that we're serving our longtime customers, those customers who've been with us for decades. And I really appreciate this slide. So thank you.
Yeah, my pleasure.
All right, Director Yoder.
Thank you. I too appreciate the slide, and I appreciate the title of talking about capital expenditures philosophy. And I to keep adding to the same sentence, and. You know, I appreciate you, Javier, and senior management offering this as a framing for the board. I think this is where our discussions oftentimes needs to be. You know, we've talked earlier about being too deep in the weeds and trying to, you know, keep kind of a higher level of discussion. It seems to me that embedded within this slide, and maybe framed a different way, we might talk about capital expenditures and an issue of modernization or transformation. And I guess while the corporate operating plan does that, at some point, I think I would appreciate a discussion around that kind of framing. Doesn't have to be today. It doesn't. I just think it would be a nice thing for us to discuss.
Duly noted, and I completely agree. Thank you, Director Yoder.
All right, I don't see any other hands right now.
Okay, so we can go to the next slide. So the next slide talks about long-term debt financings. It is important to remember here that we have been active in the market. We have been going out into the debt market, the capital markets here recently, but it's really, really important also to remind our public and everyone who's watching that we really haven't had the need to issue debt necessarily to fund and expand our capital operations. What you see here in 2017, 18, and 19 really were efforts to refinance in a way. We use different refinancing techniques. We use ways to use some of our cash on hand and defease debt. All of that was really to result in a debt portfolio that looked the same or smaller balances, with an interest rate that always resulted in lower interest rates. So we have been active going out to the market, but it has not been to fund necessarily new capital or to augment our debt portfolio. I want to be a little bit careful with that, because in 2019 we did issue debt to finance new capital, but we used exactly the same amount of cash on hand to defease all debt. So it resulted in a net reduction of debt service. Now, 2021 is different. 2021, we are expecting to go out to the market, as I mentioned earlier. We have a $360 million capital project. It's too large for us to finance it with current year revenues. So this is the moment we've been planning for. We've been getting ready for this moment. We've been paying down our debt. We haven't been issuing any new debt, or we haven't been increasing the debt portfolio. We've been planning, we've been preparing for this time, and so this is where our financial metrics will allow us to go into the market and hopefully be an attractive investment to investors who are looking at OPPD as a fiscally prudent utility that has a low debt ratio, that has good financial metrics, and hopefully that results in lower interest rates we pay on this debt. Right now, the amount that we put in the budget, again, it shows $125 million as a par amount of bonds we will issue. I can guarantee you that number is wrong. It'll be something a little bit different. Could be 130, could be 121 million. Whatever the dollar amount is will be determined by market conditions at the time we issue the bonds. All of it is to result in net proceeds of approximately $160 million to fund a big portion of our capital program. We're planning to go into the market late next year, and we will obviously come back to the board when we're ready to issue bonds. As we always do, the board would have to approve a resolution authorizing us to issue bonds, and we will keep the board appraised. I will also take a moment here to remind the board that in December, one of the resolutions that we will ask you to approve is going to be the one that we always ask, which is an authorization for us to finance new capital investments with debt. Now, we're planning to finance just a portion of our capital portfolio with debt, but if market conditions are appropriate and we have that ability, that resolution always gives us that ability to go back, issue debt on a tax-exempt basis, and that's why we will need that resolution in December. The same resolution that we've had for years.
Luis, do you have a question? Director
I
Mulder,
think
do you have a question? Or is that a stale hand?
That's a stale hand, sorry.
Okay, no worries.
Director McGuire, I am very happy to announce that the total amount of our long-term debt, all of our long-term debt, is less than $2 billion. And in fact, excluding the separate system debt, it's about 1.7 billion. I don't have the exact number, but I'm sure I can phone a friend and I can give it to you here in the next few minutes.
Okay. Also, can you discuss the mini bonds? Is this the last year for our mini bonds?
Oh, yes. So great question. Mini bonds will be paid off. The last payment of the mini bonds will happen in October of 2021. It's the last year. Not only is it the last year, but I've been actually working with my team. We have about 1,800 bond holders of mini bonds. I'm going to oversimplify these just for illustrative purposes here. Most of those bond holders have been used to receiving bond payments, mini bond payments that are relatively smaller than the bond payment that they are likely to receive this year. A lot of these bonds were capital appreciation bonds, so you get the big payment when the bonds mature. So we're working really hard, not only to continue to make the payments to all bondholders like we always do, but also to actively communicate with those bondholders and let them know, hey, making sure that we have the right address, the right person, because the payment is not going to be a small payment. It might be a significant payment to those bondholders. We will be actively working to notify bondholders ahead of time. But to your point, yes, this will mark the final year of mini bonds, and that will have an effect on the COP. I'm going to talk about that here in just a minute.
Okay, there are no other questions right now.
Okay, so next slide, please. Net income. This is just a result of all of the numbers, all of the planning and budgeting that I've been describing. At the end of next year, we're budgeting a net income of positive $42 million. It could be larger than that, and if it is larger than that, and if it results in a debt service coverage that is higher than 2 times, then we'll have another discussion next year of what we do. Going back to Director Williams' question earlier, what you see here in 2020, and of course I am not projecting how the board will decide, but this is the proposal would be, if all things considered, all things being equal, excuse me, we would potentially end the year in a position where we could potentially make an additional contribution to the decommissioning and benefits reserve account of approximately $28 million. Now, there's a little bit over 50 days left of the year, so I don't want to count on this amount. Please note that it's very preliminary, but just to give you an idea of the magnitude of what we could potentially use to help fund the decommissioning and benefits reserve that would be used eventually for decommissioning or for benefits. And like in the same vein, we're expecting. We're not expecting to have any deposits to that account in 2021. My friend just came back to me on the amount of debt outstanding, Director McGuire. current debt, excluding NC2 separate system debt, is 1.72 billion as of October.
Thank you.
Significantly lower than it has been in the past. It's a lot of money, but it's significantly lower than we've had in the past, and it is commensurate with the assets that we own.
Can I ask one other question about the decommissioning and benefit reserve? Having that reserve and also the rate stabilization reserve, does that help us with our bond ratings?
Oh, absolutely. Absolutely. So a few things. The rating agencies and investors, they look at us always from a risk perspective. How risky of an investment is to invest in OPPD's bonds, right? What is the risk of default? What is the risk that the utility is going to run into some problems that could potentially result in defaulting on their debt, right? That's really what they're looking at. Having those funds, the rate stabilization fund, is incredibly important for them because they know that is a tool that the board has when there is a need for increasing rates. The board can use that fund to feather in or gradually apply a rate increase. Right? So it's important because it helps with rates and the customer's ability to pay. And then on the decommissioning and benefits reserve is an additional fund that we have that could help in case some unforeseen event happens with decommissioning and we find ourselves in need for an additional $120 million. We wouldn't have to increase rates and have a rate shock with customers. That investors don't like to see that. So it is always a positive for them. When we eventually use the decommissioning and benefit reserve account, that's not going to be a negative necessarily, because that will be used to extinguish a like amount of liabilities. So from their perspective is a positive.
Great, thank you.
Yep.
I don't see very clearly what we're planning to contribute to the pension beyond just the decommissioning and benefits reserve account. Is there a separate line item that we are expecting to make a contribution, or actuarial required contribution? And where can I find that in the document?
You can find it in the document. If you give me a couple of minutes, I can tell you which page, but we do put in that information in there. We're planning to contribute to the penny our required ARC, our actuarial required contribution. But if you give me here a minute or two, I can tell you which part of the document you can find that in. In the meantime, if you don't mind, we can keep moving.
Absolutely.
I'll get back to that.
Okay.
Okay, so the next slide, please. Days cash on hand. Again, very important for us to maintain our days cash on hand in that gray area per our AA rated peer group by Standard & Poor's. Again, this does not include liquidity facilities. It's just cash that we will have on hand. We're planning to use a little bit more cash in 2021. We have large construction projects, timing of which requires us to use some of the cash, but it's always still within that 150 to 275 days cash. Going back to your question, Director Buckner, I don't have a page exactly, but the contribution for 2021 is $60.4 million to the pension fund.
Okay. Thank you.
Yes.
Javier?
Next slide. Yes.
In computing the days cash on hand, are we using, is it $1 million a day, roughly?
Well, so with all the days that we have, with all the cash that we have on hand, the idea is if we stop receiving any more cash, how many days of operations can we survive? And this is 178 days of operations. So it's not $1 million a day, because every day it costs us more than that to operate the district, but it's 178 days of operations we could survive without any cash coming through the door. And that's a measure of risk that investors and rating agencies have.
So is it difficult?
It's approximately $2.2 million per day.
Okay, all right, thank you.
You're welcome. Okay, next slide, please. Very little to talk about this one. Director McGuire, you asked about the rate stabilization account. It's alive, it's healthy, it's well. We're not planning on increasing the amount. We constantly check in with rating agencies, our financial advisors, and assess whether or not we need to increase the balance. At this point in time, we don't see the need or the benefit of doing so. So we're planning on keeping that fully funded at $50 million. The next slide, please, shows, I've talked about this topic a lot this morning, but it's that decommissioning and benefits reserve account currently sitting at $94 million. It shows 2019, but that's what we have today. And then at the end of 2020, or shortly after the beginning of the year of 2021, all else being equal, these could go up to $122 million. Again, just as a reminder, the potential liability that we are facing on the benefit side, it's about $480 million of unfunded liability. So these represents about a quarter of that liability. Very important, but clearly not enough to completely eliminate it. But that's why it's so important for us to continue to focus on these, and when we have a chance, make that contribution and significantly make an improvement on the funding of our pension plan. Next slide, please. This is a question I get a lot, and I'm happy to be able to show it here. I'm pretty sure that our customer owners and people watching these may have similar questions in the past. We have this large project, our decommissioning of a nuclear station doesn't happen every year, so it's large, it's complicated, and the funding of it is also complicated, and so this picture is a depiction of where have our trust funds been historically. You know, the ending balance, how much we put in every year, how much we take out every year, and how the work that we continue to do continues to reduce that liability. There's less and less work remaining to be done because we have continued to not only spend money but actually do work and get things done. So again, I couldn't be happier, and every time I have an opportunity to commend Mary Fisher and her team, Tim Euling, Ted Main, and everyone, all the women and men at Fort Calhoun Nuclear Station, they've been doing a fantastic job with these. We have, from a budget perspective, of course, there are lots of other filings we have to do with the NRC, and I am not going to get into that today, but we have to assume something for next year's budget, and we're assuming the remaining liability for that project to be about $645 million next year. At the end of the year, we're planning to have about $567 million funded. So you can see the gap has been narrowing. We know it's not fully closed, but it's very, very close to be narrowed. This is why I keep talking about this topic and a benefits reserve account simultaneously. At some point, we will have the opportunity to make a decision whether these nuclear decommissioning trust funds are sufficiently funded with a risk level that we're willing to accept, and then when can we use the remaining of the fund to potentially pay down the benefits liability.
Director Williams has a question.
Yep, sorry, I had my video off there for bandwidth. In looking at the last slide, the decommissioning and benefit reserve accounts, and this slide, the trust contributions, can you help us make sure that we're seeing things correctly here? Does this slide show the balance in the decommissioning and benefit reserve account itself?
No. The slide, slide 41 that you have in front of you, that does not include the benefits and reserve, the decommissioning benefit reserve. Thank you for the clarification. This is exclusively trust funds, nuclear decommissioning trust funds. In addition to these, that's where we have the other decommissioning and benefits reserve account. That is on top of these. They're separate, they're complementary. But it's not included in here. Thank you for that clarification.
And so what we see in 2020 is 146 million in the trust contributions, and then that puts the ending balance at the end of 2020 at 557. We're projecting another 133 next year, and the ending balance there. So I guess I just want to make sure I'm understanding where that gap is, and after. As you said, at some point after the ending balance is greater than the remaining liability, the gray box, largely the contributions from the annual budget to the decommissioning fund, would no longer be necessary.
Yes, with a big caveat. So the ending balance, we have to remember these, we have two big variables that are playing here. One of them is inflation, and the other one are interest rates. So there will be a time, and Mary, please chime in. There will be a time when we will complete the majority of the decommissioning work, but we will still have liabilities to continue to operate our ISFISI facility, right? The dry cask storage and all of that fuel continues to be an expenditure. We have to continue to fund it. We will continue to fund it with this trust fund or funds. until that time and date when the Department of Energy finally takes that fuel off. So there will be a liability for us for a really, really long time. We will have trust funds that will be funded, but those funds will be invested in fixed income securities. By law, we cannot invest in equities or anything else, so it's fixed income securities. For example, today, with interest rates being so low, the fund has, all of a sudden now, the fund cannot assume higher earnings in the future because we have low interest rates today. As interest rates go up, then the fund all of a sudden has a better investment earning potential, and that helps with the funding side. Simultaneously, you have inflation that's helping or hurting, right? With inflation costs, inflation expenditures could also go up or down. The idea is that if inflation and interest rates hold together and there's correlation between those two, any inflationary pressure that we may see on the expenditure side of the remaining decommissioning expenses should be offset by interest earnings. That doesn't always happen, right? You have many economic reasons why that not always happens. So your statement was directionally correct, but I did want to point out that once we achieve funding, we can't just claim victory and say we're done, right? There will be many, many years where we will have to continue to monitor these, see how our investments are doing, see how inflation is affecting these, and always making sure and reporting to the NRC that we have adequate funding and adequate risk controls. Mary, did I miss anything?
Just quick, piggyback on that real quick, Javier, that line, it's great to see the remaining liability trend going down. Could you remind us when what the trajectory is for when we're going to get that down to a meaningful, pretty material, perhaps not zero, but getting close to it?
On that one, I would need Mary probably to chime in. It's really when the majority of the work that we can complete on deconstructing the site and cleaning the site and really just finishing with the remaining expenditures of the SVC facility. But I don't have, I don't feel I have the authority to do that.
Yeah.
So if there's anyone on the call that wants to bail me out, please do so.
Mary, you might be double muted. Is your cell phone muted?
It was. Thank you, Mo. I was talking, but nobody could hear me. The project is scheduled to be substantially completed in late 2025 into 2026. So that's the time frame that we're looking at. So a few more years yet. We have substantial work to be done.
So that might be the timeline as well for us to contemplate what to do with that benefit or that decommissioning and benefits reserve account as well. Is that right?
It might be earlier than that, Director Buckner. I think it's part of the funding. We may have adequate risk mitigation items where we may actually talk about this as early as next year, right? We don't have to wait for everything to be done. It's really the relationship between funding and the remaining work to be done.
If you look at that ending balance and where the liability is, you start to see those two things converge. And at some point, what we'd want to do would be to pull out of the trust fund and not have substantial amounts remaining there to support the rest of the project. And so, as Javier is saying, it's been projected in 2021, 2022 that we would meet that objective, and then we would go to the NRC and request to be able to withdraw the funds from the trust fund as opposed to adding in the contributions. As Javier said earlier, we'd have to balance that every year just to ensure that we were meeting the requirements that we need to with the NRC, but we could as early as next year into 2022 look at do we really need to have additional funds going into the trust fund in order to cover the liability.
Thank you. Just a quick time check. We were hoping to break for lunch at noon, which is in about 7 minutes. So
okay, I can try to do it quickly. The remaining slides hopefully are more self-explanatory. Happy to answer any questions. The next slide is our debt ratio. Again, we have continued to lower that ratio. It increased when we decommissioned the nuclear station. Our net position took a big write-off back in 2017, so that mathematically our debt ratio increased. But as we continue to add more capital, pay down debt, and not expand the amount of debt outstanding, that ratio has dropped down from 64% in 2017 to, we expect that to be 56% in 2021. So not a big effect by issuing new debt. We will have, and this is something that I projected, I talked about the public meeting at the PRB, that by 2023, when we finish issuing debt for power with purpose bonds, we're expecting that ratio to be around 57%. So still in that acceptable range between 50 and 60% of that ratio. The next slide, please. Coverage ratios. This is Director McGuire. You talked about mini bonds. These funny-looking line, I'm going to describe it like that. It's a reflection of mini bonds. So what happens? Mini bonds are considered subordinate lien bonds. So we have the vast majority of our debt service has a senior lien on our revenues. They are senior to. We have to pay that debt first before we pay all other debt. We have, and of course that debt usually carries a lower interest rate because it's less risky. Investors like it. In previous years, because of market conditions and many other factors, we have issued subordinate lien bonds. These are bonds that have a subordinate relationship with the senior lien. They usually carry a slightly higher interest rates, slightly interest rate, but we've chosen to do that again for market reasons that were prevailing at that point in time. Mini bonds fall in that category of subordination to senior lien debt. So in 2021, it is no accident, it's no coincidence that we knew that mini bonds were going to have a higher payment in 2021 than we've had in the past. It's capital appreciation bonds, most of them. There's a higher payment of mini bonds in 2021. We scheduled lower payments of senior lien debt in 2021 on purpose, right? It's so that we can continue to have a level debt service. You can see that the green line of total debt, we're still anticipating that to be 2 times debt service coverage. But in 2021, temporarily, it looks like our senior lien debt service coverage is increasing a ton, and it is, but it is by design. We're having lower payments of senior lien debt service in 2021. We will resume with higher payments in 2022, so I expect that line to come back down to the levels that we've had historically. So that's one of the effects that these mini bond payments are having on our ratios. Ultimately, what investors and rating agencies, they look at both the senior lien coverage and the total debt service coverage, and the fixed charge as well too. That is the end of my presentation with slides. I just want to talk quickly, the last 2 slides, talk about next steps. We have retained New Gen Strategies and Solutions LLC. This is a consulting firm that comes in and reviews. They meet with our teams. They ask a lot of questions. They've already done that. And they're basically making sure that the resources, the dollars that we're putting into the operations of the utility are in line with prudent utility practices that they see elsewhere in the country. They would raise a hand if they see us underfunding certain functions, if they see that we forgot or we're ignoring certain aspects of our operations. So it's a second check it's almost like a benchmarking, if you will, from this company that gives the board an extra layer of assurance that this COP, the way we've put together the budget, is prudent, and it'll continue to deliver power and services to our customer owners the way we have in the past. You will see that the preliminary COP that is posted, and that one will have it. I think it's just like a one-page letter. It's a preliminary letter. That letter will be longer. I think it's 4 or 5 pages long. Once we have the final version, the final COP that will be presented to the board for approval in December, that one will have the longer version of the letter that goes into more detail about the review.
All right, so just to confirm, we'll have that final letter from NewGen before we approve the COP.
Correct. It'll be part of the approval packet of the final COP in December. Right now, there's a preliminary letter. It's a shorter version of it, but the longer one will be for the final one, and you will have it before you vote.
Thank you. Director Williams, do you have a question?
I guess kind of a summary question overall. I wasn't sure if we reached the end. I think we were close, but just at the end.
I think you can ask it.
Oh, great. Well, I guess looking overall at the document, in thinking back through some of the previous meetings where we've discussed some of the priorities during monitoring reports, I looked through this document, and I've mentioned in the past that one of my priority values is a focus on addressing climate change based on scientific information and recognizing environmental justice. And in the past, my comments were that I didn't see either of those terms specifically listed in previous documents. And so as we look to prepare this document going into next year, I just wanted to make sure to express that those are priorities for me. And as we express the values of our organization, I hope that documents, as I think Rick has pointed out in the past, a budget is a moral document, that we express our values through the way that we set priorities in our budget. So kind of a general comment about a focus on and recognition of climate change and environmental justice in this document. And then secondly, my question in our past discussion about the potential for additional revenue or additional funds available at the end of the year ties kind of with some of that prioritization as well, where there have been times throughout the last roughly 18 months since the decarbonization investigation process began where specific questions have come up, and the answer has been that will be included in part of the decarbonization investigation. And there have been other times where we've been told that we'll need to make sure we prioritize what types of work can be accomplished through the decarbonization investigation based on the staff time and other resources available. So as we look at the end of this year with the potential for additional resources available, specifically in the financial area, we can translate that into availability of other time, and that's through consulting. And so as we look at some of the kind of innovative and market transformation outcomes that have been discussed a variety of times in a variety of different meetings, I hope that we can find a way to help make sure the resources are available to accelerate all of those things that we've talked about, and that we don't end up constrained during 2021 when we expect the decarbonization investigation to be completed at the end of the year. I hope that we don't end up constrained where we had not enough staff time or not enough support for external consulting so that we could achieve some of those transformative types of things that we've talked about in a variety of different places. So I'm not sure how to have that discussion today or Thursday or as we look towards December. But if we're talking about prioritization, my priorities would be that we make sure we provide the resources necessary to investigate some of those new areas, and that we balance that against some of the investment into the decommissioning and benefit reserve fund. So if anybody has a discussion about how we have, or an idea about how we have that discussion, I'd appreciate hearing it.
So, Director Williams, one thing that I failed to mention is we had a very robust discussion on strategic initiative funding. And what I can tell you today, and I don't have the table in front of me, is that we have allocated significant amount of dollars to all strategic initiatives. Decarbonization, pathways to decarbonization being one of them, but not being the only one. The customer strategic initiative, the grid modernization initiative, BT transformation initiative, and even our human capital workforce transformation initiative. So we have dedicated dollars for in 2021 to continue to advance these initiatives. That's the augmentation of the budget that I talked about earlier. I failed to specifically call out the strategic initiatives, so I apologize for that. But we have made significant increases and commitments. What I really like about the way we've done this is that these are increases, these are investments that are sustainable. These are not one time, we had a little bit more money, let's just do a one time, and then next year we may not have enough, and then we stop the initiative. That's one of the things that we've been trying to avoid, making sure that we have a good financial framework where we can continue to sustain these type of investments, whether it's pathways to decarbonization or whatever successor initiative we have on these one. That's how we are building this budget, to make sure that not only are we investing to meet all the strategic directives, the 15 that the board has told us, but also the strategic initiatives that Tim Burke has laid out for the organization, and that we are funding them going forward.
If I can also mention, as far as your comment, Eric, about the market transformation stuff, we are going to be discussing that in detail in the governance report as far as board work plan. Okay, I'm done with that. Any other comments?
All right, Director Yoder.
So a follow-up question, I guess, how, and maybe a follow-up question that needs to happen, outside of this forum, just because I'm a slow learner. But how do we judge whether this strategic, the input, the resources, the capital, put into this is sustainable, or this investment in that strategic initiative is sustainable? And how do we, is it the same calculation, and do you tie it back to where the money comes from? I'm a little confused. I understand your conclusion that the investments are sustainable for the outcomes, but I'm not sure how we get there.
Right. So maybe a way to answer this is, we don't know the long-term outcomes, right? This is what we're doing with the strategic initiatives today, is helping us identify what more work that we will do in the future. For example, pathways to decarbonization. It's studying how we would continue to decarbonize the fleet. It's not necessarily all the work that's going to be needed. So when I say it's sustainable in the way that it's funds that we're not taking away from any other function. It's funds that we are dedicating to this one function. These pathways to decarbonization strategic initiative will eventually come out with some recommendations. Those are not going to be funded with this amount of money. We will have to make then other decisions in the future. Those might be significant investments, and we will make those investments in the future. So the funding that we have set aside for strategic initiatives today are commensurate with what the strategic initiative is set to do, to study, to understand, to get all this clarity. In some cases, like grid modernization and the business technology, we are making changes. We are already investing in technology. So it is it's very much in line with what the strategic initiative charter and the goals of each strategic initiative is trying to do, and the work that is planned for 2021. So it's not a promise that we'll have everything funded and we're in a good place, but it is one where I know that we have sustainable funding to continue to fund these initiatives, at least at this level going forward. These initiatives will come to an end. We will have other initiatives, and it helps us know that we're not taking away any funding from any other function, but rather we're continuing to fund these initiatives. It's not only to meet the strategic directives, but it's to meet, anticipate, and expand what the new board of directors, your successors, will come up with and help us shape what the strategic directives will tell us.
Thank you.
Yeah, thank you for the question.
Dr. Moody?
I'm interested in a little bit of clarity, and perhaps this is just sort of formalizing for the public's sake, the way in which the utility is able to assist customers that are having trouble paying their bills. We'll talk about our customer first solution stuff later this afternoon, but from a budget standpoint, as we look to 2021, can you help me understand what, if any, changes we're making in order to set aside more funds to provide that kind of assistance? I know we don't do it directly, we do it through third parties, but can you give me the lay of the land there?
On this one, I'm going to call Julie. Thanks, Julie.
I can answer that hopefully. Thank you for the question, Director Moody. So a couple things that we have in our plan for 2021 is our low income energy efficiency program. You know, we had piloted a new approach to that. And so we will be rebranding that and I'll say offering it beyond our pilot level in 2021 is what the plan is. And then another area is with regard to the low usage, low income program that we had put in place to assist customers that had lower usage in conjunction with the transition for the rate restructuring that we had done. So that program is set to expire in 2021, and we had expanded that program to kind of align it to the 5-year general rate freeze that we had put in place. And so the team is going to be looking at what are other program options in order to assist folks who need energy assistance in the long run, or on a, I'll say, more persistent basis. So those are a couple things off the top of my head that we are planning to do in 2021.
And one other thing that I mentioned earlier is also Julie's budget, or the customer accounting and services budget, includes amounts for write-offs, and it's not necessarily an assistance to the customer, but it's something that we're used to and we have to account for as part of the budget.
All right, I don't see any other questions right now. Javier, do you want to take us through the next steps slide?
Certainly. I think we've talked about most of these. So as we have, as tradition has it for OPPD, there's no action for the board on Friday. This is the preliminary view. What we do is we let these documents, both this slide deck and the preliminary COP are already posted on OPPD.com under the meeting agenda items. We leave it, I used to say a month, but it's about a month, whatever time frame is between the November meeting and the December meeting, for review, for your, you will have more time to review it, to provide comments, for the public to provide comments, and also for us to finalize. There are just a few final things that we still need to tie out. So there will be maybe just a handful of very minor changes or edits to the document, with information that we will still get for the remaining few weeks. But the idea is that for the December 8th committee meeting, I will present the final COP. I'm not going to go through the same presentation, so you can breathe. I'm just going to talk about the changes or a very summarized version of this presentation, and then it'll be up for board approval on December 9th, along with the FPPA change and along with the capital expenditure resolution that I mentioned earlier today.
All right, thank you. Just for clarity, how should the public provide feedback on this? Is it just through the board contact page, reaching out to board members, or is there a specific way that we want to receive those comments?
Any and all, I would say, and Lisa's team does a fantastic job with OPPD Listens. That's a really efficient way for us to process those, or through chatting with you directly and you providing those comments to us. We're agnostic. Feedback is feedback, so we're happy to take it.
Okay, very good. Let's see, Director Williams, do you have another question?
Just a process question here. As we've talked about this today, and it's not an action item, will there be any discussion on Friday, or the next discussion is next month? What's the next step there?
So typically, I would present something similar at the board meeting in November. And I apologize because I don't have clarity on that one. I can certainly do that again on Friday. given that we have these WebEx and it's all recorded and it would be the same venue, the same media that will happen on Friday, I'm happy to just point people to watch the recording. Either way, I'm going to phone a friend on this one and maybe ask Scott from a governance perspective, what do you think?
Thanks, Javier. The reality is, as the board reviews the agenda at the end of this meeting, it'll make the determination as to what it would like to do. So that would be the course of discussion. And so at the end of it, I would invite the board to consider where it would like that discussion to happen. And it could happen either way. To your point, Javier, we're flexible.
So for clarification of my question there, I guess I'm not looking for a re-presentation of the same material on Friday, but I do hope that some of the directors would also have time to express if they have priorities that they would like to talk about at the time when we are taking input on the budget. I expressed some of mine. I hope others have ideas about how we make sure we highlight in the budget where things have been allocated and how that meets some of the things that we've talked about in past months, because this is the one time throughout the year that we set those financial priorities for next year. I may be gone at the end of today. I have some other commitments, but I guess I will look forward to seeing how that comes up on Friday. Thanks.
All right, thank you, Director Williams. All right, I think with that, I see no other hands. Just taking one last scan here. I believe that concludes the November finance report.